Welcome to Skilled MBA Case Study Series in Accounting. EqCap's mission involves quantifying downside risks in micro, small, and medium enterprises financing. Analysts must evaluate financial health, focusing on liquidity and solvency. This requires a deep dive into financial statements, cash flow analysis, and market conditions. Understanding these elements is crucial for making informed funding decisions and ensuring sustainable growth in India's micro, small, and medium enterprises sector. Analyze 5 micro, small, and medium enterprises, each with distinct business profiles in India's dynamic landscape. Evaluate their liquidity risk to identify which can meet short-term obligations. Based on these assessments, recommend which enterprises should receive debt financing considering their risk profiles. The micro, small, and medium enterprises sector in India is diverse, spanning textiles with its labor-intensive, inventory-heavy nature, and construction reliant on milestone payments. Automotive demands capital and supplier ties, while food processing faces perishable inventory and thin margins. Services, though asset-light, hinge on skilled workforce retention. Each sector presents unique liquidity challenges. Liquidity analysis involves calculating key ratios like current, quick, and cash ratios using balance sheets and cash flow statements. These ratios help in making informed decisions to approve, reject, or modify financing terms. Industry benchmarking is crucial to compare these ratios against sector standards, ensuring financial stability and strategic alignment. Key liquidity indicators include the current ratio, quick ratio, and cash ratio. The current ratio, ideally between 1.5 and 2.0, assesses short-term solvency. The quick ratio, over 1.0, evaluates immediate payment ability. The cash ratio, above 0.5, measures survival without new sales. These ratios are crucial for financial health analysis. Excessive inventory reliance can mask liquidity issues, as a healthy current ratio may hide a poor quick ratio. Seasonal cash flow volatility with large liquidity gaps poses default risks. Customer concentration, where over 20% of revenue comes from one client, can lead to crises if payments delay. Negative cash flow trends often signal impending defaults. In the textile industry, raw material price volatility and long inventory holding periods pose significant risks. Seasonal demand fluctuations further complicate financial stability. These factors can exacerbate liquidity issues, especially when inventory constitutes a large portion of current assets, as seen in some manufacturers. Understanding these risks is crucial for effective financial management in this sector. A textile manufacturer with a current ratio of 1.8 seems healthy, yet a quick ratio of 0.7 indicates a liquidity gap. Inventory comprises 61% of current assets, highlighting stock dependence. With inventory days at 45, turnover is slower than the industry average, suggesting potential cash flow challenges. Identify seasonal cash flow patterns by mapping peak cash needs against low revenue periods. Analyze customer payment terms to evaluate potential delays from key accounts. Review supplier arrangements for flexibility in payment schedules. Examine existing debt obligations to check for bunched repayment schedules that create pressure points. Collateral requirements involve securing personal guarantees or specific assets to mitigate risk. Seasonal repayment structures align payment schedules with cash flow patterns, ensuring financial stability. Enhanced monitoring through monthly financial reporting is crucial. Loan covenants set minimum liquidity ratio thresholds, providing a safety net against financial instability. The decision-making process begins with an initial screening, reviewing basic financial statements and industry position. Detailed ratio analysis follows, evaluating liquidity indicators. Industry benchmarking compares metrics against sector standards. Cash flow stress testing models payment ability under adverse conditions. Finally, a recommendation is made to approve, reject, or modify financing terms. The analyst recommendation framework involves a structured approach to evaluate micro, small, and medium enterprises' creditworthiness. Analysts conduct a comprehensive review of financial statements, perform detailed ratio analysis, and benchmark against industry standards. Cash flow stress testing is crucial to assess payment capabilities under adverse conditions. The final recommendation is based on these analyses, determining whether to approve, reject, or modify financing terms. Master financial ratios to evaluate micro, small, and medium enterprises' creditworthiness, focusing on liquidity metrics. Recognize industry-specific risks impacting liquidity, and make informed lending decisions despite incomplete data. Develop risk mitigation strategies tailored to diverse risk profiles, ensuring robust safeguards are in place. Liquidity is crucial in micro, small, and medium enterprise financing, often outweighing long-term profitability in credit decisions. Each industry has unique cash flow patterns and risk profiles, necessitating specialized analysis. Structuring financing to balance opportunity with downside protection is key. Continuous monitoring is essential as micro, small, and medium enterprise liquidity positions can change rapidly, demanding vigilant oversight. Thank you and understanding. The skilled MBA advantage involves engaging with practical finance through real-world scenarios. Our case-based learning approach equips you with the skills needed for effective financial analysis and investment decisions. Join our Quick Case series to deepen your insights and enhance your decision-making capabilities in dynamic business environments.